Rohr here with an early global view on Friday, July 17th, 2015. It's currently 6:45 a.m. U.S. Central Time, and we especially want to note that the recent strength of the equities has been based less so on the mixed data which we've seen and more so on the constructive comments from Janet Yellen Wednesday into Thursday and Mario Draghi at Thursday's ECB press conference. So when we ask what has this in fact meant to the markets, we look at the S&P 500 hourly on the left, 30-minute on the right as usual. This is September futures. And we can see how that Greek agreement, the sense we were going to have somehow or another the Greeks actually sign off on the deal that was finally agreed under the gun out of the weekend into Monday, and the idea that this was going to occur, of course, even buoyed the market last week back up toward the top end of that old 2075 to 78 area. And gapping up on Monday, the market pushed up initially only up into 2,090 to 88, but by later on in the day Monday, we were up to above 2,090. Now that naturally, of course, knocked out the Fibonacci retracement resistance from the entire move down, and we will expand the hourly chart now. The entire move down from this last high going back here to June 22nd up in the 2121 area to the lows that held repeatedly into 2040 to 37 with only some slippage. So that was a big sign you could go back up toward these highs up here at 2121. And part of the reason that's so important as we then escape the 2100 to 2096 resistance, and just as a sign, not to be too self-promotional or anything like that these technical levels can work very well. Note, even on the late session weakness going back to Wednesday, looked like the market might have rolled over, been ready to head back down a bit, but the bears couldn't get it below 2096. When a market's trending higher, it can't break support on pullbacks. It tends to, continue higher. So here we are, with the market having pushed up yesterday from 2100, and for all of these old interim levels, there typically isn't much between 2100 and the old failed up break at 2119, which is more or less where we're trading now. We're up one at 2118, so in other words, right back into yesterday's high. So there's not much usually between 2119 and the lead contract 2125 congestion resistance. That was small gaps in congestion. And you'll note also that the hourly MACD, for all the markets churning, grinding higher quietly, it's never gotten back below the upper runaway band since it escaped going back into mid-morning last Friday. And that pretty much does it for the short-term view of the S&P 500.